Good. What is different in Fab Fashions that you should take note of? The first thing is the profit before tax calculation. Go and have a look at that. The second thing is dividend calculation. Make sure that you can do that. And the third thing is the calculation of new machinery that they have actually purchased during the year. So those three things, that's a little bit more tricky than in other questions, so go and have a look at it. Fab Fashions is a leading fashion house. They started on 1 September 2015. They have 800,000 ordinary shares, 300,000 compulsory convertible shares, and 200,000 redeemable pref shares authorized. The statement of financial position as at 31 December 2017. Property, plant and equipment, investment in listed shares, current assets, and then we have capital, stated capital, ordinary shares. You can see quite an increase there. Convertible pref shares, there's nothing left at the end of the year, so obviously something must have happened with that. Revaluation reserve, 90,000. So when we get to PPE, don't forget about that one. Last year, nothing. So that full 90,000 must have happened in the current year. Retained earnings. And then we have quite a number of non-current liabilities. We have a 10% interest-bearing loan, 15% debentures, nothing last year, this year 200,000, and 15% redeemable pref shares. Current liabilities, trade and other payables, current tax payable, and shareholders for dividends. Good. Now, additional information. The first part is all about share capital. The second part is all about non-current assets. Then dividend and income tax, long-term loan and debentures, and general information. An allowance for credit losses is maintained at 12% of trade receivables. Dividend income was 23,000 and total revenue was 600,000. Prepare the statement of cash flow for Fab Fashion for the year ended 31 December according to the indirect method of IAS 7. You only need to prepare the operating activities and investing activities sections of the statement of cash flow. Okay, indirect method, so there's no reconciliation note. So where do I start? I start with profit before tax. Now, before we're going to get to profit before tax, I want us to do our non-current assets first. Why? Because there's a lot of answers that we're going to derive out of non-current assets. When you start with a question like this, you're going to write down the framework of the question, which they all look the same, and as we go along, you will just complete all the missing figures. During the year, Fab sold a machine which was used to manufacture dresses. The machine was sold for 30,000 Rand profit. This machine had a cost of 90,000 and it had accumulated depreciation of 60,000 at the date of sale. Good, so let's start then with our machinery at cost. Cost price of machinery will have an opening balance of 400,000 and a closing balance of 620,000. Our accumulated depreciation, that is going to have an opening balance of 80,000 and a closing balance of 150,000. There's the closing balance, there's the opening balance. Great, so we have sold a machine, cost price 90,000 and accumulated depreciation 60,000. So to the asset disposal account, we will take out 90,000, 60,000 accumulated depreciation. We have sold it at a profit of 30,000 Rand. So therefore here in our profit, in our asset disposal account on the debit side, profit on the sale is 30,000 Rand. Now when we balance this off, obviously the proceeds on the sale of the machine 60,000 Rand, and we go and dump it where we should in our statement, in our cash flow statement. So here's our cash flow from investing activities. Just see, let's make it a little bit bigger. Investing activities, there you can see then proceeds from the machine sold, there it is 60,000 Rand. 60,000 Rand proceeds from the machine sold. Then you know that you have written down your template for your cash flow. It's the indirect cash flow. So you know that the profit before tax, which we don't know what it is as yet, needs to be adjusted for non-cash flow items, separately disclosable items, and changes in the working capital figures. So we have one already. Profit on the sale of the plant, 30,000 Rand. It has increased our profit, so therefore we're going to take it out, minus 30,000 Rand. So you can complete it as we go along. Then they tell us another machine had to be written off during the year due to irreparable damage done to one of the models. But unfortunately, okay, she lost it, blah, 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 blah. The machine had cost 24,000 Rand and the accumulated depreciation was 21,000 Rand when it was written off. Fab sold the machine as scrap to an entity that repairs these type of machines and collected 1,300 Rand cash. So therefore we have to remove that out of our books as well. 21,000 and 24,000. 24,000 cost to asset scrapping account, 21,000 accumulated depreciation to the asset scrapping account. We have received 1,300 Rand for that machine. So the loss on the scrapping of the machine equals then 1,700 Rand. So under our non-disclosure or under our items that does not represent the cash flow, we can add that loss on scrapping of the asset, 1,700 Rand. It has decreased profit initially, so therefore if we want to eliminate that, we have to add it back to the profit. Also, we have the proceeds on the scrapped assets sold, 1,300. So under investing activities, proceeds from machine scrap, there it is 1,300. Good. Now, that is all that they tell us about non-current assets. So if we go back to our asset accounts themselves, we have balance of the asset disposal account, asset scrapping account. If you go to the accumulated depreciation account, you are missing a credit entry. And the credit entry that you're missing is the depreciation expense for the year. So by balancing this account off, you're going to see that your depreciation for the year must have been 151,000. Once you have the 151,000, you're going to dump it on your cash flow statement. In your cash flow statement, under your non-cash flow items, you're going to have depreciation 151,000. You're going to add it back to your profit. Why? Because initially it reduced your profit. Then when we're going to balance off our cost price account, you will see that you are actually missing a debit entry here, and that must be new machinery that we have acquired. And the balancing item there, yeah, is those two together. Let's just read the share capital before we're going to close off that account completely. On 1 January 2017, Fab had an opening balance of 300,000 ordinary shares. On the same date, Fab issued 150,000 ordinary shares at R1.15 per share. Of these shares, 50,000 shares were issued in return for a new machine which was acquired at the same date with a cost price of 57,500 Rand. So what did we do? We didn't pay the guy in cash. We gave him 50,000 shares. So therefore, that entry must still be posted in our cost price account. On the debit side, we would have debited our assets with 57,500, and we would have credited our ordinary share capital with 57,500. There's no cash flow involved there, guys. There's no bank underlying. I debited machines, I credited capital. That was my entry. So therefore, the balancing figure that we're looking for is the 276,500, and that then represents new assets, machinery acquired, and here acquisition of machinery 276,500, and let's assume that that was for replacement. Why? Because we have sold and scrapped machinery during the year, so I think that is safe to say But this must have been for replacement purposes. 276,500 an outflow of cash. Great. Coming back to our PPE, we haven't done land as yet. So let's draw a T account for land. Opening balance 300,000, closing balance 500,000, and then we had a revaluation reserve of 90,000. So it will be our opening balance plus our revaluation reserve less our closing balance. That will give us the new land that we have acquired during the year. So acquisition of land and buildings was 110,000 rand. So I haven't put it down somewhere in writing, but you can do it for yourself. It is my opening balance, 300,000 plus 90, 390,000, less closing balance of 500,000, which will give us that acquisition of 110,000. Good, that then is machinery. Now let's move back to our profit figure. And for that, let's quickly read what they say about share capital. We have done the 57,500, we've done the additional share issue. Of that share issue was this 50,000. Everything has been taken into account correctly. Some compulsory redeemable pref shares were redeemed on 1 April 2017. All amounts due, inclusive of the dividend, were paid on 1 April on the said shares when it was redeemed. No redeemable pref shares were issued during the current financial year. So if you go to our statement of financial position, you will see there that we have redeemed some of these shares, 200,000 Rand worth of those shares on 1 April. So let's go and calculate our interest. We have it, we're busy with that, so let's do that. The interest, let me see here, redeemable pref shares, 350,000 multiplied by 15%, multiplied for 3 months, that is up to the 1st of April, was 13,125. From the 1st of April until the end of the year, 30 June, that was then a total of 9 months, and that gives us then 16,875. Just check, our year end is 31 December. So from the 1st of April up to the end of December, that is the 9 months, and that will give us that interest. So total interest on redeemable pref shares, 30,000 Rand. On 30 June, we don't have to do the financing activities, so we're not worried about the amounts that we've paid back. On 30 June 2017, Fab converted all its compulsory convertible pref shares into ordinary shares. So halfway through the year, all 200,000 were converted into ordinary shares. So therefore, we will have a dividend, a convertible pref share dividend, based on 200,000 multiplied by 15%. The rate was 15% on the compulsory shares. So let's do that dividend calculation as well. Convertible pref shares, it's not dividends. We had 200,000. We had it for a period of 6 months when all the shares were converted after 6 months. So therefore, our total dividend there was 15,000. 200,000 times 15% times 6 months. Then the last thing that they tell us is that share issue expenses paid during the year of 20,000 Rand was closed off to retained earnings. Now just keep that one for a moment at the back of your mind. We've done non-current assets. Let's see what they say about dividends and income tax. All amounts due in terms of dividends payable and taxation payable at the beginning of the financial year was paid during January 2017. An interim dividend of 20 cents per issued ordinary share was declared by Fab on 31 May 2017. Now that date is fairly important because this conversion of shares, where is that? This is the converted, all compulsory convertible pref shares. This conversion of shares, that took place on 30 June 2017. So that 30 June 2017 was after the interim dividend was declared. So if we want to work out dividends declared on ordinary shares for this year, it would have been that 300,000 which we had initially, plus the additional 150,000 shares that we have actually issued during the year. So remember that 50,000 was included there because I said of these shares 50,000 were issued. Okay. So in total we had 450,000 ordinary shares at the date of interim dividend declaration. The dividend was 20 cents a share, so that will give us 90,000 rand. 450,000 times 20 cents, 90,000 rand. We've done the convertible pref shares. Now, dividends declared was 105,000 rand. If we go to our financial statements, they will see that we have an opening balance on shareholders for dividends of 24,000 and a closing balance of 15,000. So if we're going to do the T account, opening balance 24,000, closing balance 15,000. We have declared in total the 90,000 plus the 15,000, which is 105,000. So therefore it means by the end of the day that we have actually paid there 114,000 rand worth of dividends during the year. Now you can go and dump that on your statement of cash flow and then you know it is done. Dividends paid. Yeah, under operating activities, 114,000 rand. Then we're done with that one as well. Good. Now we have completed a number of entries up till now. Let's do financing costs in total. Here's the tax. During the 2017 financial year, Fab paid outstanding income tax of 2016 and provisional income tax of the 2017 financial year amounting to 7,800 rand. So let's do the receiver of revenues account. The receiver of revenue had an opening balance of last year, tax payable of 7,000, a closing balance of 10,000. Let me just find it. Yeah. An opening balance of 7,000, a closing balance of 10,000. They said that they've paid that 7,000, which was outstanding in the beginning of the year. They also told you that they made provisional tax payments of 7,800. So if I do balance of this account now, it will give me my tax expense for the year in the income statement of 17,800. Now, why do I want the tax expense? Guys, because they don't give me profit before tax or profit after tax. I have to calculate my profit before tax. And how am I going to do that? I'm going to do that by using my retained earnings. My retained earnings had an opening balance of 80,000. It had a closing balance of 250,000. What happens with retained earnings? I'm going to add to retained earnings my net profit after tax for the year. That's my X. I don't know what it is. I have deducted in the current year share issue expenses of 20,000 against the retained earnings. So that it was plus 80,000 minus 20,000 plus X minus the dividends which I have declared for the year, which I have just worked out as 105,000 rand. It was 105,000 rand. So I had the 80,000 minus 20,000 minus 105,000 minus X equals 250,000, our retained earnings at the end of the year. And that means that our profit for the year, which is the balancing figure there in the X in this equation, is 295,000 rand. This, however, is profit after tax. Let's write it in there. Profit after tax for the year. Now, what do we show in our note? We show in our note profit before tax. So therefore we had to redo this account in order to get our tax charge. Our tax charge then is 17,800. So therefore our profit before tax must have been 312,800, and that is that 312,800 that we start off there, profit before tax. Now this is the only question that you had, that you have to do it in that fashion. And I think it's extremely good that you go and look at it, make sure that you understand it, because it's for sure not the last question that you're going to come across, which you're going to have to calculate this profit before tax, and you're going to follow this route in order to derive them. Okay, now non-cash flow items was depreciation, the profit on the sale of the asset, and the loss on the scrapping of the asset. Remember here, they've told us under other information that an allowance for credit losses is maintained at 12% of trade receivables. Now, if I go back to my statement of financial position, it means that my trade receivables, as I actually gave it to me in the statement of financial position, was after this allowance of 12% was deducted. So that means by implication that the 140,000 equals 88% of the gross debtors, and the same thing applied to the 110,000. So you have to work out what was the actual amount of gross debtors. Now gross debtors must have been 159,091. That times 12% will give you an allowance of 19,091. 110,000 last year's balance equals 88% of the gross debtors. So the gross debtors was 125,000. 125,000 multiplied by 12% equals 15,000. So it means that my allowance account must have increased from 15,000 to 19,091 in the current year. So there was an expense in our income statement of 4,091, which does not represent cash flow. So that 4,091 was an expense. It reduced our profit before tax, so therefore I'm going to add it back. Allowance for credit losses. With then separately disclosable items, dividend income. They gave us our dividend income for the year. They told us that our dividend income for the year was 23,000 Rand. And that we have now actually recorded. Let's just complete our interest calculation. We've done our interest calculation on the redeemable pref shares, but that was not the only long-term commitment that we had. We had 15% debentures of 200,000, and we had a 10% interest-bearing loan. Now, Stan Bank, who is the lender of the interest-bearing loan, granted an increased facility to Fab on 31 March 2017. Fab immediately borrowed the funds made available. Interest to this loan is not capitalized to the loan account. No loan repayments were made during the current financial year. So if we go and have a look at the loan increased there from 350,000 to 150,000. And they also told us, no, sorry, not that one, yeah, from 220,000 to 300,000 with 80,000 Rand. They also tell us that that happened on 31 March. So for 9 months of the year, my outstanding loan balance was 300,000, and for 3 months of the year, the outstanding loan balance was 220,000. So therefore, our 10% interest-bearing loan interest was 220,000 times 10%, which was for the full year, and 80,000 times 10% for 9 months equals 6,000. Guys, you could have done it the other way around as well. It would have given you exactly the same question of the same answer. If you have said that 220,000 times 10% times 3 months equals then 5,500. 300,000 times 10% for 9 months equals 22,500, and if I added 22,500 to the 5,500, it also gave me 28,000 Rand. So it doesn't matter how you calculated it, the answer still being 28,000 Rand. Good, so the total interest on the redeemable pref shares, we've already calculated that is 30,000, and then they've told us that the debentures was issued at year end. 100,000 15% debentures were issued on 31 December 2017, so there's no interest applicable on those debentures for this year. So our total financing cost, 58,000 Rand. So here, separately disclosable items, interest expense, 58,000 Rand. And now underneath, we're going to show our separately disclosable items. You could have added dividend income, 23,000 already. Interest expense, 58,000 already. So it's exactly the same. There was no accrued expenses or accrued income applicable. So therefore, the amounts in the income statement also equal the amounts actually received or paid. Dividends paid, we have worked this one out of 114,000, and taxation paid, we have also worked that one out as 14,800. Remember, here was the taxation paid, was the 7,800 plus the 7,000, and that was our 14,800 there. Let's quickly have a look at changes in working capital. Our inventory figure has increased from 90,000 to 130,000. So that represents a cash outflow. Where is that? There. Cash outflow of 40,000. Now for your trade receivables, you must be careful because the trade receivable figure, as you see it there, is after the allowance was actually deducted. So when you worked out the gross amount of trade debtors here, there, remember we divided it by 88%. We actually worked out the gross amount of our debtors being 159,000 in 2017, 125,000 in 2016. So that means the difference between those two will give us our movement in debtors. So there was an increase of debtors of 34,091. Increase in debtors is an outflow of cash, so therefore the minus sign. And then the payables, that's our trade payables then. There was a slight decrease in trade payables. And that's also cash outflow then. Where do we see that? Here, decrease in trade creditors, outflow of cash of 6,500. So if we now add up all these amounts, that will give us our cash flows from operations of 409,000. We've already discussed our separately disclosable items, all of them. So therefore now we can complete this section, cash flow from investing activities, 525,200. Our cash flow from investing activities, we've done the machine scrap, machine sold, acquisition of machinery, acquisition of land and buildings, and acquisition of investments. That one we haven't done. If you just look at your investments, last year nothing, this year 200,000. So that is where that increase in investments is coming from, also cash outflow. So if I add that all up, that gives us a 525,200. This year, this total year is that one there in red, cash flow from operating activities, 230,200. Good, this is actually a very good question. There's a lot of catches in this question, so go and have a look at them all.